It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank in Formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank, and the first thing I want to do is welcome our new listeners. We have several stations that have come on board this year in 2023, and it's exciting to have you on board. And since we have some new and even first-time listeners, I want to go to the basics and first of all say, what is your personal bank? And very quickly, straight up, I'm just going to tell you that your personal bank is a financial concept that strategically integrates financial tools from the banking and insurance industries, and the goal is to continue growth on funds even after you access them for other purposes. Now, again, you can earn the money safely, with guarantees, income tax-free if done properly. We have companies that are paying up to 6% dividends currently, and with increasing interest rates in the future, but with higher interest rates, we're going to see higher dividends in the future. The future is very bright. So we're very excited about this, and I just want to say very excited to, like I said, introduce a number of new people to this little-known financial concept by the average American. It's used extensively with institutional investors, banks, large financial institutions, corporations, things like that, wealthy families. I'm going to go into this further so that if this kind of piques your interest, it's definitely something that's different than what most people are familiar with, but again is very, very effective and can go a long ways to dramatically changing your financial trajectory, particularly at a time where there's a lot of economic uncertainty. Like I said earlier, we got guarantees, we've got 6% dividends, we got tax-free, we got all these things going on, and we can actually create a positive arbitrage scenario, and that is where you're earning more than you're getting charged depending on your situation. So these are all exciting things, very unique, very different, again, from many, many other financial tools out there. So let me get into it. But before I do that, just give me a couple minutes, if you don't mind. And again, bear with me if you've been a listener of this show for a number of years even, because we have so many new listeners with new stations on board, especially today. I really want to go back to the basics, introduce myself and what this concept's about and what it can do. So first of all, who am I? Well, I'm Ference Toth. I've been in the financial industry now. I'm going on my 23rd year. I own a financial insurance agency. I'm actually I guess you might say a serial entrepreneur. Being a business owner, entrepreneur is really where my heart is at. I've owned several businesses in my career. I started with a retail business. I've owned a landscaping and sprinkler installation company many years ago. I actually got injured through a couple of car accidents. It had nothing to do with work, but I got rear-ended a couple of times. And if you own a landscape plant nursery and a landscape company and you're doing sprinkler installations, you can just imagine that's a lot of physical. Even though I was the owner of the company and had quite a few employees, you still you still got to put your hand to the, you get dirty and you work hard. And I injured my back is what happened on our car accident, got rear-ended. So I had to make a change, and that's where I got into the financial world and found out I had a knack of it. And I actually started selling annuities, of all things, for retirees. I became one of the most successful agents in the country. I was top 10 in the nation for one of the largest annuity companies in the country. And again, focused on retirement, safety, guarantees, things like that. And then I was introduced to this personal bank concept after owning my own company, starting my own company about 18 years ago now. And, it has revolutionized our financial future, both personally with our business and with our clients. So I founded Secure Estate Management, and I've also founded Your Personal Bank, which we trademark. And more recently, I was the chairman of the board of an FDIC insured bank in formation. That's a brick and mortar business bank that we were in the process of opening in the Phoenix, Scottsdale area, actually. Unfortunately, more recently, that has not come to fruition like would have liked to seen. So I have stepped back from that role to focus more on my business and my clients, which we actually have since we started in 1996. We have over 5,000 of those clients, and we're A+ rated with a Better Business Bureau now. We'll be going on our 19th year actually on that, so that's pretty exciting. But you can find me at yourpersonalbank.com. That's our website. That's probably the best place to go. We also have an app. It's Your Personal Bank by Integrity. And what's exciting about that in particular is I've been on the radio sharing this concept now for going on 3 or 4 years. And so there are several years worth of shows that are on the website that you can go back. Each has its own topic on what I've been discussing. So there's tons of content on learning about this concept and how it works. And again, if you're interested in diversifying your money, looking for some safety, some guarantees, you want some tax-free, you want liquidity, access to your money, maybe even some positive arbitrage, then Your Personal Bank is certainly something you should look into. And again, go to yourpersonalbank.com, our website, to get more information on this. Lastly, I'll share my purpose is really my family, my wife and daughters. We've been married over 20 years. I've got 2 lovely daughters, teenagers, and those are my reasons for what I do. I also served in the U.S. Army, went to college afterwards, helped pay for college, and I've been a semi-professional bass trombonist of all things. I was into sports and music, so my wife calls me kind of a Renaissance man, a jack of all trades, if you will. I just like different things, and I find it very interesting. We'll put it that way. So that's a little about myself. I don't want to delve into that too much further. Again, go to my website, yourpersonalbank.com, if you want more information about me or how this works. But I'm also going to share that in this show. What is your personal bank? Well, what it is really quite simple. It's a 2-step process. The first step is we set up a high cash value policy, and it's designed to maximize tax-favored cash growth, okay? We want the money to grow. We want to maximize liquidity. And again, we're using an insurance tool, but it's the opposite of how most people view and use insurance. And this is the paradigm shift in thinking, okay? This is it. You know what I'm talking about. Most folks, when they're looking at life insurance, you know what I'm talking about. You want to pay the least amount of money for the biggest death benefit, and that is what's called a death benefit protection tool. I get it. I have some of that. It's necessary for many folks, but that is not what we're discussing or talking about today. See, this is the point where if somebody misses the whole idea, the whole concept, I'm going to tell you straight up, this is it. This is where they miss it. Again, they get hung up on the idea of what their perception is of what insurance can do. It can do many different things. And what you have to realize is it can be an asset versus an expense, like most people view or use it that way. And if you do, you miss the whole point. Now, again, we're maximizing cash. We're growing our money, gaining liquidity, getting dividends. Now, who do we use? Well, there's over 800 insurance companies in the U.S. There's about 40 of them that are mutually owned. Now, there's a really strong reason why we want a mutually owned company. And you've heard of many of them, like Mutual of Omaha or Northwest Mutual, Mass Mutual, and many others. The reason we use a mutual company versus a stock-owned insurance company is there are no stockholders. In other words, all insurance companies pay dividends. Not all of them, but many of them pay dividends. But if they have policy owners and stockholders, they have to split the dividends between the two. And most companies are paying in the range of 5-6% these days in dividends. That's the norm. And I'll talk about that further, how that's been the norm for a long time, decades. Do you want to split that dividend with the stockholders, or you want to keep it all yourself as a policy owner? See, that's a no-brainer. That's pretty easy. And that's why if you're a policy owner of a mutual company, you keep all of the dividends. So that's easy. Out of those, there's about 15 or so, give or take, companies that have mutual companies that pay dividends for over 100 years and never missed a dividend. In other words, they paid dividends every single year through both world wars, the Great Depression, the Great Recession, you name it. And many of those companies, in fact, most all of them, are well positioned. Cash reserves are set to pay dividends out for the next several decades, literally, some even for a lifetime. That's the kind of cash reserves they have. So as far as paying dividends in the future, with many of these companies we're working with, we have no concern whatsoever about them paying the dividend into the future. Now, out of those 15 or so companies that have been paid dividends for over 100 years plus, there's 3 of them that are what's considered the top dividend payers. These are companies that have been paying 5.75 to 6% dividends or higher every single year for the last 25 plus years. And all 3 of those companies happen to have never missed a dividend since before the Civil War. I'm going to say that again one more time. You've got 3 companies that have never missed a dividend for over 170 years plus. They've never paid less than 5.75% dividends for the last 25 years plus. These are the aristocrats. These are the best, highest paid dividend payers. They're all A-plus rated. All 3 of them have tremendous cash reserves. And if I said the names, which I won't at the moment, you would know them immediately. You would recognize them. Now, if you want to learn the names of these companies and who they are, I'm not going to give away the whole store right now, but the one thing I'll hold back, I'll share everything except that because I want you to contact me for more information. And you can do that via call me at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422. And yes, if you call, you will actually get me, Ference. So now out of those 3 companies, I'm going to tell you this. One of them has lower fees, lower costs. And lower fees means more cash. So out of the 3 top dividend payers, there's one today, and has been that way clearly for the last several years now, is the clear cash winner, the one that generates and grows and gives you the most cash on a guarantee with guarantees, minimum 5.75 to 6% dividends. Expect them to increase in the future, and income tax free. Okay, that's pretty awesome. So, like I said, if you want more information on this, contact me at 866-268-4422 or yourpersonalbank.com. And I'm going to encourage you to stay tuned in the next segment because I'm going to go in further about how your personal bank works and how it can enhance your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're welcoming some new listeners. We have several stations that are coming on board for the first time beginning of this year, 2023, and it's really exciting always to have brand new listeners, first-time listeners. So if you've been listening to the show for a number of years, I'm going back to the basics today about what is your personal bank. I'm also sharing some updated information for 2023, so it'd certainly be valuable to continue to listen. And obviously, this would be a great show if you have somebody you know of that would be interested in more information for them to listen to. You can go to yourpersonalbank.com, my website. You can listen to this or any of the previously recorded shows. You can share it. You can listen to it. And I always encourage anyone that reaches out to me and contacts me to listen to this or an intro show that I do on what is your personal bank before we chat, because that'll bring you up to speed. Again, how do you grow your money tax-free with up to 6% dividends today? Expect those to increase in the future with guarantees, tax-free, and even get positive arbitrage. Contact me, 866-268-4422 or yourpersonalbank.com. Now, like I said in the last segment, we're using an insurance tool not like most people are familiar with. We're maximizing cash growth. We're actually minimizing the death benefit. Again, it's the opposite purpose on how most people view and use life insurance. We're using it to maximize dividends, maximize growth, maximize cash, and again, minimize the death benefit. If you have a death benefit need, by all means, I'm not negative to that by any means. I can share with you who offers the best deals in that arena, but that is not what we're talking about today. That's not what your personal bank does. And by the way, last thing I'll share on that is if you have a policy that was designed to maximize, or you thought, we'll put it that way, was designed to maximize cash, I'm strongly going to encourage you to contact me because, one, the products have improved over the last couple of years significantly, partially through tax law changes that occurred about 2 years ago. That's part of the reason, and they've gotten more efficient. And lastly, interest rates have gone up, so there is higher dividends to be had. So if you have a policy that's, say, more than a couple of years old, it would be really, really beneficial to your benefit to compare the numbers. In most cases, we're getting anywhere from 20 to even 50% more cash year one and every year to you, the client, versus what you had before. So if you're interested in that, at no obligation, no cost to you, I'll show you a head-to-head, apples-to-apple comparison, how to maximize cash safely, tax-free, with guarantees. Contact me, 866-268-4422 or yourpersonalbank.com. Now, again, why are we using an insurance tool for the personal bank concept to grow the money? Well, there's actually several reasons why. First of all, we want to compound our interest. We want our money to grow, and we want it to grow compound each and every year. That's the best way long-term to grow wealth. Anyone who understands wealth generation understands that concept of compounding your money over time. Secondly, we want no risk of loss. You don't want to, if you're going to access the money and use it at some point, whether it's in the short term, maybe to pay off some debt, purchase some items, or use the money and invest in other assets, or down the road more long term to supplement retirement, for example, you don't want to access against it or borrow against an asset that may lose value. It's the analogy I share with people all the time. If you're a real estate investor and you're going to buy a property to rent it out, and you're going to take a mortgage, borrow funds to do this, do you want a fixed or variable mortgage? And the answer is always you want the fixed mortgage. The reason why is simple. You want to know your fixed costs. So then if you rent it out, you know that if you can rent it for more than your expenses, you get to keep the difference or the cash flow or the positive arbitrage. That's what we're doing here with the insurance tool. It's not just a straight investment. Again, that's another point that many people, if they miss the point, this is where they miss it. You know, if you start comparing this to just another investment, and you're saying, well, I can make X amount of return on asset investment one and X amount of return on investment two, it's a pretty straightforward analogy. Which one's going to give you a bigger return? Certainly there's liquidity factors, perhaps tax factors, and risk factors to deal with. But first and foremost, you're looking at the return. Well, again, I like to use the analogy of the rental property here because really what you're doing with your personal bank is generating growth and income. And your money continues to grow against the asset because you're using it as collateral. You're borrowing against it, much like a property does. You purchase a property and you borrow against it using using the value of the property. A mortgage, for example, is a common use of that, and then you rent the property out at and earn a higher rate than what you're getting charged, and you're keeping the difference, and that's your cash flow. Okay? That's your positive arbitrage. That's one of the best analogies I can give you on how your personal bank works. The only difference is, so there's two main differences. The first one is we're using the cash and the policy as the equity, as the asset, versus in real estate, you're using the value in the property, right? The equity in the property. So we're using cash versus equity, okay? And the second advantage of that is the insurance policy is guaranteed. It will not lose value, okay? The type that we use. Real estate, although not, typically, but we do know scenarios like in 08, 09 is a good example of where real estate can lose value and you can get upside down. Here you cannot. You're protected on the downside. You cannot go upside down. It's pretty nice. And then the last benefit, of course, is you're building wealth much like people do with real estate in cash flow, positive cash flow, but without having the maintenance of a property. And a lot of folks really do like that because you're just using the cash as the asset, as the equity, if you will, to borrow against, to use those funds, again, to pay bills, purchase items, or invest in other things. Obviously, if you've got positive cash flow from a rental property, you can take that extra money and do other things with it, right? Okay, you're doing the same thing here. Plus, you can use the principal also, much like you can with a mortgage, or if you take a cash out refi in a property, you could do the same thing because there's value there. So it operates in many ways very similarly to a real estate type of investment. Again, the asset, the tool we're using is cash in a policy. The other thing is you have more access to your funds than you do with real estate. Typically, in many cases, a lender will only loan you about 80% of the value of a property. Well, in a cash policy, they'll typically loan you 95% or more even. So there's a lot of benefits to this. So you have access to more of your funds day one. And, of course, tax-free growth and access and to the heirs is a really nice attribute for a lot of people. So I'm going to go into this a little further on the access side of how you generate income. So I'm going to recommend you stay tuned on this. If you want to contact me with more information, it's 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422. Stay tuned in the next segment. You won't want to miss it because I want to get into some really valuable information. So again, don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're welcoming a number of new listeners because we have some new stations, so welcome. And going into what is your personal bank? How can you grow your money with guarantees, earn up to 6% dividends today? We expect higher dividends in the future with higher interest rates, with guarantees, no market risk, and income tax-free. Also, you can have access to your about 90% liquidity on your money day one. We know of, most of us know of other assets, investments, things like annuities or CDs, for example, where you can grow your money and have some safety. But obviously, those don't have anywhere near the liquidity. They have liquidity limitations, and that's often their biggest limitation for folks. Here you have up to 90%, I'm going to say between 80 and 90% liquidity on your money, depending on how we set it up, day one. Even the worst case scenario, if we're going to grow something more long-term where you're going to be more modest and building it over a long period of time, you're still looking at least 50% liquidity day one. So there's lots and lots of liquidity here. Again, 6% dividends today. Expect those to be higher in the future. Income tax-free and with guarantees, no downside. In fact, not only no downside, guaranteed you're going to go up each year. That's what's really cool. Now, there are other options, too, out there. Sometimes people ask me, well, you're talking about a fixed option, a guaranteed option. Yes, of course I am, because you having that consistent, steady, compound growth over time is a really, really powerful way to build wealth. It's over time, it's the best way. And the numbers bear that out. But there are other options if you want to consider more aggressive upside potential through indexing. We can do that on a number of different indexes, most commonly the S&P 500, but also others. And you have the advantage of gaining double-digit returns in good market years when the markets do go up and not losing on the bad years. And gosh, 2022 was one of them rough years for a lot of people. So having no downside in a rough year like that can be really attractive. Now, the average returns on these things have been in the 7 to 8% annually. And again, that's income tax-free, folks. So if you figure that out over time, that gets very, very interesting. And it's not like you have to choose between the steady, consistent compound option or the index option where you have more upside potential with no downside market risk. You can do some of both. You can actually blend it or combine the two, if you will. So it's a very, very interesting way to go. Now, I've kind of mentioned a little bit. I'm talking about the policies and how we're building cash, we're maximizing cash growth, we're getting dividends, like I said, 6% currently even. But how do you access the money? Well, in most cases, most investments out there, any type of financial account that is, the way to access money is pretty straightforward. You take a withdrawal and you do what you will with the money, spend it or otherwise. And obviously, the amount in the account is less what you took out. Therefore, the future growth is less as a result. Use a simple example. If you have a $100,000 account and you take $10,000 out of it or 10% of it, then obviously you got 10% less. You now have $90,000 left in that account for it to grow. And therefore, the growth on it the following year would be less. Okay? Even if you had the same percentage. So the amount you grow each year, let's say you're taking funds out of an account to supplement retirement, for example, or income for any whatever purpose, you obviously have a diminishing account over time. Therefore, the amount of returns are diminishing because there's less and less money there, right? And that's one of the problems of most financial accounts of any kind. I'm talking stocks, bond, mutual funds, CDs, annuities, you name it. Take your pick. That's the challenge of those. Well, one of the major advantages of your personal bank is instead of taking withdrawals from the account and reducing the overall cash that's actually in there, instead you actually take a loan either through a bank line of credit or a policy loan. We can do it either way depending on whichever has the lower rate, the lower borrowing rate, that is. Okay? And because we're taking a loan against the asset and the cash in the policy is the collateral for the loan, okay, we're not reducing the amount of cash in the policy, are we? In other words, 100% of the money that's there stays there and continues to earn dividends or indexing each and every year. Therefore, you get full growth each year, and in fact, increasing growth each year, because the account's growing whether you're adding money to it or not. Therefore, your dividends or whatnot are increasing each and every year. You have an increasing return asset. Now, I'm going to talk about this further in the last segment, so I'm going to really encourage you to stay tuned on this, because what it does is that it creates an increasing income that you can live on, say, through retirement, unlike most accounts. Contact me at 866-268-4422 or yourpersonalbank.com for more information. Again, 866-268-4422.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. In the last segment, again, I'm going to welcome our new listeners, our new radio listener. We got several new stations in 2023. Pretty exciting. And to have new listeners is always a great thing. I'm sharing today, since it's the first show for many of you, what is Your Personal Bank? For those of you who've been listening for even several years, this will be a great refresher with some updated information, which in fact right now I'm going to be sharing. At the end of the last segment, I talked about the difference of how your personal bank works in terms of distribution, withdrawals, if you will, income, than a typical investment account of any kind. I'm going to reiterate this one more time because this is so important. We all know that if you have an investment, a portfolio, an asset, whatever it is, a financial asset, and you start to withdraw money from that asset to generate income or supplement retirement, whatever, we all know that as you take money out, there's less money left in the account to generate future growth, right? So the hope is The amount you're taking out is not more than what it's earning. So if you, for example, if you got to keep it simple, if you got a 10% return on your overall account and you took out 10%, you would not be taking from any of the principal. Now, of course, it would grow. It would not grow anymore, but you're not, at least not touching the principal. That's pretty rare. In other words, what I see most often for most people is they're taking an amount out of their accounts that exceeds the overall growth of the account. So in other words, they're gradually dwindling down the overall value of the portfolio, right? The total account value, right? That's pretty common. So you have a dwindling return on your money. And the thing is, depending on how much money you have put away and depending on how long you live will determine whether your money will last or not. In other words, will you run out of money before you run out of time? And for most retirees, that is a very, very big concern. In fact, oftentimes the number one concern, because we have some uncertainties involved with that. One, what is the return on the money going to be? Well, certainly if it's market related, that's an unknown year to year. Secondly, how long are we going to live? That typically is also another big unknown. Thirdly, how much is inflation or cost of living or maybe unexpected expenses going to affect our retirement, whether it may be medical expenses or whatever? Again, those are all unknowns that are impossible to predict. We can run simulations, we can run estimates, but all of those things are, you got several series of unknowns, and it's somewhat difficult, if you will, to try to, with any level of certainty, to know whether you're going to have enough money or not, right? And it's a valid concern of many retirees. Well, what I want to say is your personal bank can help offset that problem. And the reason is really quite simple. It's all about in how the money is accessed when you use it. As I stated earlier, instead of taking a cash withdrawal, which is certainly an option you can do, but not recommended with your personal bank, like other accounts, when you take a cash withdrawal, you reduce the amount of cash or amount of money that's in the account. Therefore, future growth is diminished. Well, with your personal bank, you don't do that. We actually take a bank line of credit or a policy loan, and again, that's determined by which rate of interest is cheaper, which is lower. The bank rate's lower or the policy loan rate's lower. Now, I'm going to give you an idea. Right now, things are a little out of whack. We're in an unusual, extremely unusual economic scenario, particularly with interest rates. But even with this historical, generational interest rate environment where we got high inflation and high interest rates and all that, we're still able to access money at least less than or at equal to the cost of what we're borrowing it against. In other words, we've got companies that are paying 6% dividends and charging somewhere around 5% or so loans, okay? Loan rate. So if you're at a, let's say, 6% dividend and a 5.25% loan rate, you're still keeping the difference about 0.75 of a point. Now, I can tell you historically, normally that difference, that gap, that positive cash flow is usually more like 2 to 3%. It was definitely last year and for a number of previous years where we were getting 5 to 6% dividends and borrowing rates were in the 3 to 4% range. So people were earning 5 to 6 and getting charged 3 to 4, keeping the 2 to 3% difference. That's more of the norm. We will see that going forward because, as I've stated several times in this show, dividends are currently at 6%, but historically, on a normal interest rate environment, they're 7 to 8% is the norm, and interest rates have been going up, and the dividends will very logically, they follow interest rates. They're very interest rate sensitive, so we will see higher dividends. Therefore, our positive arbitrage scenario will return, okay? Or better, wider positive arbitrage will return, and most likely we're looking at next year in 2024 and beyond. My point is this. What I'm trying to get at in a long-winded, and I apologize for the long-winded response there, or explanation. And what I'm trying to say is When you access the money, and think about this a minute, this is a significant difference to any traditional financial account. When you access the money through a loan, whether it's a policy loan or bank line of credit, you're not reducing or taking money from your account. You're not reducing the cash in your account. In other words, all the money in there is still earning dividends. So all the money that you've contributed plus all the gains it's earned over whatever period of time it's been there is continuing to earn dividends going forward, or interest credits going forward, which means every year there's more money in it, right? Which means you have an increasing asset even when you're accessing income from it because you're borrowing against it. And the borrowing costs are less than what you're earning, even in a crazy environment like we're in now. Therefore, the amount of money you have available to supplement retirement is increasing on an annual basis. Now, how's that for an interesting way? This is you start to understand why wealthy families and corporations and institutions use this tool, because it can generate an income, an increasing income each and every year. If you want to learn how to accomplish the same thing so that you're not looking at a dwindling growth scenario, but an increasing growth scenario into your retirement years and beyond, well, guess what? Contact me at 866-268-4422 or yourpersonalbank.com for more info. Again, it's 866-268-4422. Now, probably one of the last things that I get asked about is, okay, this is very interesting. You've opened my eyes to something, an opportunity that I wasn't aware of before, okay? And I get this so often, and the question is, well, why haven't I heard about this before? Well, the thing is, it's really quite simple. It's a very specialized area of the financial world, okay? I use the analogy of doctors. I mean, how many medical doctors are out there versus how many brain surgeons, okay? It's obvious. There's very few. This is a specialty. Secondly, again, as I've stated several times before, this is a tool that's often used by banks, corporations, institutional investors, wealthy families. We're talking about folks with like 10 million liquid assets and above is normal. The rough, typical delineation for that is according to Wall Street. So in other words, those people use this tool quite often. Because remember, you got liquidity, your money's growing each and every year, tax-free. That's really important to any high-income earner. But unless you are dealing with a financial person or advisor that's dealing with that type of clientele, it's very, very rare. I mean, you're talking about less than 1% probably of financial advisors that ever in their career deal with that type of clientele. And for a number of years of my career, first half of my career, decade or so, I didn't either, even though I was one of the top annuity producers in the country with one of the top annuity companies for 4 years straight. I shared that in the first segment. It's just even the advisors typically are not taught this, nor do they run into it or have experience with it. It's just a lack of knowledge. And it's not like if you had a rich uncle or something, or you knew somebody who was very wealthy, that they sit down and tell you about how this all works, because what's the point? Why would they, right? Okay. So it really comes down to that lack of knowledge. And then the last one is not how should I say? Not the best reason, but it's accurate, and that is the commissions, the earnings that an advisor gets are less on this than a typical, say, selling a fund and or money under management and that kind of thing, which is the more common scenario that most people run into. So the advisor makes less money. So if you think about it, if you're not very familiar with it, maybe never ran into it themselves, plus there's less money in it for the advisor, there's not a lot of incentive, right, for somebody to share this for a person. Now, I'm an unusual scenario. I was introduced to this about a decade ago. We had at that time something like 4,000 clients in our agency through doing through networking, workshops, all those kinds of things, dinners, all those things, right? And we were meeting with our clients on an annual basis, doing reviews anyway. And I thought to myself, how hard would it be to introduce a new concept that could dramatically enhance our clients' financial futures, reduce their taxes, increase their returns, increase their liquidity, have some guarantees, all that stuff, right? Get some positive arbitrage. How hard would that be to introduce it to our clients who we're meeting with anyway? Well, obviously, it was incredibly easy, and we opened up an entire can of worms is what happened. Suddenly, our clients started recommending folks that they knew, like relatives, friends, business associates, and such, and said, hey, you need to talk to them because this is awesome. This is incredible. And we started getting referrals like I've never seen in my entire career, and realized we were onto something. And then that led to speaking engagements. I started traveling around the country. I've spoken to investor groups all the way from Chicago to Seattle to LA to Texas and everywhere in between. So roughly the western half of the United States. It got so intense for a period of time that I was on the road 14 weekends of 16 weeks. And I have a family, and I realized I've got to back this off a little, and I started getting more particular about my speaking engagements. And then the radio situation came about. It wasn't something I was looking for, but I realized, hey, it landed in my lap, and I was asked to present this and share this idea on the radio. And I realized this was a great opportunity to share this with a wider audience even. And then additional stations have reached out to me. I have not reached out to a single station ever. They hear what I'm doing. They hear the show. They hear what we're sharing, and they ask if I would join them. So it's pretty exciting how this is all expanded through word of mouth and all, and it's just helping people enhance their financial future. And again, as I stated earlier, have an increasing income throughout your retirement and beyond. That is exciting. That is awesome. And again, getting the guarantees, getting the tax-free, getting the positive arbitrage, having liquidity of 50 to 90% day one, all those things are powerful, powerful tools, and it truly does dramatically enhance your financial trajectory. Again, if you want more information, go to my website, yourpersonalbank.com. You can listen to this or any of the previously recorded shows to get more information. There's several years of content there. Call me at 866-268-4422. Again, that's 866-268-4422. And as I always like to finish, as long as it's still on our money, I'm going to say this: in God we trust.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.